doing? Sorry I'm late.
Ananda, no problem. Yeah, it's fine. Nita, by the way, we're still actually a bit stuck on our task last week.
Oh, what's wrong?
We still have not figured out a great case that we can analyze yet.
If that's the problem, I actually prepared for you guys an interesting case that has happened recently. Do you want to check it out?
Oh, that would be great.
Yeah, sure.
Hello everyone, we're from Group 7, which are I, Nita, as the moderator, together with Keisha and Dinda that will participate in the discussion. We will be discussing the problem concerning a case of violation of the Code of Ethics committed by a public accountant from a company as part of our assignments in the course on values, ethics, and professional attitudes. First, I will explain the problems that we will argue in this discussion. There was a problem between a leading bat manufacturing company in a European country and a senior professional company providing audit, tax, and advisory services. So, one of the seniors in the company providing audit, tax, and advisory services, let's call it Company A, is being sued by their client company, we can call it Company B, because of the role of the senior from Company A in making his client go bankrupt, thereby enabling another company, namely the private equity company, we can just call it as Company C, to acquire a Company B without the burden of pension scheme obligations. The accusation against a senior at a Company A, let's call him Mr. D, by Company B are Mr. D and Company A advised and or assisted Company B and Company C in connection with the proposed acquisition of Company B by Company C free from obligation of the pension scheme at the time when there was a conflict of interest between the interests of Company B and Company C. And subsequently, the respondents attempted to develop a relationship business with Company C, and consequently Mr. D and A's company is compromised and its valuation is harmed, thereby failing to act in accordance with basic principle B objectivity and Articles 120, 210, and 222 of the Code of Ethics. And further, the respondents were seeking to develop a business relationship with Company C. And as a result, Mr. D and Company A's judgment was compromised and judgment impaired, thus failed to act in accordance with Fundamental Principle B, Objectivity, and Sections 120, 210, and 222 of the Code. Mr. D and Company A knowingly or recklessly assisted with the provision of incorrect and or misleading and or materially incomplete explanations to the PPF, TPR, and Company B and the trustees of the pension scheme regarding the cause of Company B's financial difficulties. And Company C's involvement as a white knight in relation to Company B in breach of the Fundamental Principle A, integrity, and Section 110 of the Code. Company A failed to reveal the Executive Council material facts when required, such as the recording of £45,000 of time costs prior to their formal engagement and the ad hoc retainer with Company B. Mr. D created a note of a crucial meeting some 30 months after the event, specifically in response to the pensions regulator's investigation. However, neither Mr. D nor Company A drew to the attention of either the pensions regulator or the executive council that the note was produced over a year after the meeting in question. Notices to produce material are a standard part of any investigation. However, Company A failed to conduct an electronic search of Mr. D's personal emails despite two specific requests from Executive Council. Company A instead relied on Mr. D's recollection of events over 9 years earlier. These failures meant Executive Council may have lost the opportunity to follow up lines of inquiry because in the intervening period, Mr. D's personal emails, which had not been copied to the Company A email server, would have been deleted. The tribunal held that the failure to carry out comprehensive searches in response to the specific request by the Executive Council is a serious matter, as it does exhibit a failure to cooperate. So that's what happens between the companies.
It sounds like a really challenging and interesting case. I cannot wait to discuss it.
Yeah, it sounds really engaging. It's great that you actually found this case for us, Nita.
Yeah, what do you all think about the case so far?
I would say that there is a lot of that we can analyze from this case, especially about a company A's misconduct.
What are Company A's actions can be considered as a misconduct? I mean, there are always reasons why a company has such a motive, right?
Okay, now let's discuss about why the Company A and Mr. D commit a violation.
So first, at that time, company A was providing insolvency services to company B. But while at the same time, they were trying to get company C as a client for company A. This allows company C to acquire a company B without the company B's burden of 100 million pounds worth of pension scheme. From this, we can see that company A to have acted in interest of company C.
Okay, do you think that there is a reason why Company A and B did that to their client?
I think that there actually might be reasons why Company A had a conflict of interest towards Company C. First, there's a possibility that Company A can view Company C as a large potential client. This means that if they did not have that interest, this means loss of profits for Company A as well as no financial benefits for Company C.
But however, having a conflict of interest is violating the Code of Ethics number 120 about objectivity. It states that the principle of objectivity imposes an obligation on all professional accountants not to compromise their professional or business judgment because of bias, conflict of interest, or the undue influence of others. Furthermore, by advising both parties in a deal where their interest conflict can compromise the integrity of the advice given and lead to biased decision making. This breach of integrity was demonstrated when Mr. D misled the pension regulators and PPF about what had caused Company B to go bankrupt in order to assist Company C in its pursuit of the business.
Okay, so other than violating the objectivity, Linda also thinks that Company A and B are violating the integrity as a professional. What do you think regarding this violation of an integrity, Keisha?
In my opinion, we can never truly know whether whether company A really intended to violate the integrity principle by misleading other parties. Instead, company A's conduct will be based on the theological theory, which we have learned in the classroom, specifically utilitarianism. In this case, I think Mr. D prevents Company B from bankruptcy while also at the same time giving the opportunity for Company C to acquire Company B at a lower rate. Hence, I think this creates mutual happiness for all parties. And after the acquisition, Company B actually shows a much stronger cash flow and investment in product development.
Though they show a strong improvement and development, Mr. D and Company A were found to have knowingly or recklessly engaged in activities that included providing inaccurate, misleading, or deliberately incomplete explanations to multiple entities. This includes the PPF, TPR, Company B, and the trustees of the pension scheme about the underlying causes of Company B financial difficulty. Furthermore, the tribunal's findings indicate a pattern of non-cooperation by Company A, as evidenced by A's repeated claims that Mr. D did not use a personal an email address for work-related concerns, only for Mr. D himself to admit and acknowledge the existence of such communications. Furthermore, Company A legal representatives submitted an extensive collection of documents late in February 2021, stating it was an error as the reason for the delay. This strong proof from the tribunal suggests that Mr. D and Company A violated their professional integrity. Their acts disrespects ethical values since they provide inadequate or intentionally omitted the information required for to comprehend the problem in hand. Furthermore, this breach of integrity is linked to a violation of Code of Ethics number 210, which requires Company A to consider if accepting a new client um, offers any hazards to fundamental principles, um, compliance, any hazards to fundamental principles compliance. And the breach extends beyond the values of impartiality and integrity in demonstrating a failure to uphold the core standards of professional conduct and emphasizing the necessity for carefully evaluating their ethical practices.
Okay, so what we can get regarding the violation of integrity is Keisha said that Company A and Mr. B are actually trying to sell Company B to C to prevent Company B from bankruptcy and for Company C to acquire Company B, which instead of violating the integrity, Mr. D tries to create mutual happiness for all parties.
Yes.
Meanwhile, Dinda said that Mr. D and Company A are providing incorrect explanations to the PPF, TPR, Company B, and the trustees of Company A and the trustees of the pension scheme regarding the causes of Company B's financial difficulties, which is part of violating the integrity, right? Do you guys think that there is also a relation to provisional appointment in this case?
Yeah, I think there seems to be so. When we define professional appointment, it means that A professional accountant in public practice shall determine whether acceptance would create any threats to compliance with the fundamental principles. However, determining whether the acceptance could create threats for the company could come actually from a biased viewpoint. There could be a possibility that the company may accept a client due to maintaining good relationships rather than basing their decision from their own actual analysis of the company.
I think if company A tries to maintain a good relationship to accept a client, it is already a form of conflict of interest. As a professional, company A and Mr. D should abide by the rules in order to give an unbiased decision and services. This situation highlights a clear violation of Code of Ethics number 220, which stipulates that Company A and Mr. D should have undertaken diligent measures to identify and assess circumstances that may give rise to conflict of interest. Moreover, they should have evaluated the significance of any threats posed by such conflicts and implemented appropriate safeguards to eliminate or reduce the threats to at least an acceptable level. By failing to meet these obligations, it can lead to considerable threats to observing the fundamental principles within the professional domain. In the case at hand, it is evident that Company A and B have transgressed the core principles of both conflict of interest and integrity, as they seemingly prioritize relationships uh, over the impartial execution of their professional duties. This violation not only underscores the need for a comprehensive review for their ethical standards, but also serves as a stark reminder of the importance of upholding the integrity and impartiality of their professional roles to maintain the public trust and also the confidence.
Okay, these are all interesting points to discuss. In addition, the tribunal investigation and funding shows that Company A and Mr. D wasn't fully cooperative, which in my opinion is quite suspicious. Do you all have anything to say about this?
Yeah, Company A and Mr. D argued that they acted in good faith and that their advice to Company B was sound. They also claimed that they were not aware of any conflict of interest and they did not knowingly or recklessly assist with the provision of incorrect or misleading information to the pensions regulator. Besides that, they also argued that the tribunal's findings of serious failures to cooperate with the investigation are unfair and also inaccurate. They claim that they provided all relevant information to the tribunal and that they were not deliberately trying to obstruct the investigation. So I think it is possible to say that the sanctions were received were made of an unjust standpoint.
From the tribunal's findings regarding Company A and Mr. B, it shows a series of concerning actions that underscore the need of for a thorough examination of their behavior and its potential ramifications. It became evident throughout the investigative process that Company A and Mr. D displayed a consistent pattern of non-cooperation and also deception. This lack of transparency, transparency was exemplified by Mr. D's repeated use of personal emails, despite initially denying such actions, only to later acknowledge it. Moreover, the sudden emergence of additional documents under the pretext of an error raises questions about the integrity of their response to the investigation. Actually, on one occasion, they failed to provide crucial records, attributing this omission to a simple typographical error in the search of Mr. B's name. Such a seemingly minor mistake, however, it had a significant consequences for the completeness of the investigation. Additionally, Mr. B's had dictating of meeting notes further eroded trust in their commitment to a fair and transparent investigation process. Perhaps the most concerning is the tribunal's determination that Company A and Mr. B's actions put the assets of Company B's pension plan members at risk. Many of these individuals are actually low-wage workers laboring in the bad company factories, making them especially vulnerable to the consequences of any misconduct. This revelation points to a severe breach of trust and disregard for their financial security. The tribunal sanctions, for me, it seems appropriate given the severity of the findings, and Company A and Mr. B's actions have affected Company B and its employees, emphasizing the need for the accountability. Holding them responsible is crucial to protect the financial system integrity and also the public trust, even if it causes hardships for the violators.
Okay, I see that Company A and Mr. D argue that they acted in good faith and that their advice to Company B was sound. However, the tribunal found that they failed to cooperate fully with the investigation and that they put Company B's pension plan members' assets at risk. The sanctions imposed by the tribunal are significant and will have a negative impact on Company A and Mr. D. However, the tribunal found that the sanctions are proportionate to the severity of the misconduct and that they are necessary to hold Company A and Mr. D accountable for their actions and to prevent similar misconduct from happening in the future. Ultimately, it is up to the court to decide whether the sanctions imposed on Company A and Mr. D are fair and just. The case we discussed made me think of something. What would you guys do if you witness a similar case in the company you work in?
If I were in a situation where I witnessed such a violation of ethical or legal standards, I would undoubtedly take the whistleblower role.
Yeah, for sure, Linda. I mean, I would be one too if I witnessed like a fraud, corruption, safety violations, discrimination, harassment, or basically any illegal actions within the company. I guess there could be a possible risk or opportunities when becoming a whistleblower in a company. What they think?
What will you guys gonna do as a whistleblower in a company?
So my decision to step forward and expose the wrongdoing would hinge on my moral obligation and the availability of sufficient and compelling evidence to substantiate my claims. In situations of this nature, any disclosure I make must be well supported by concrete and irrefutable proof, ensuring the credibility and integrity of my whistleblower status, and in turn the effectiveness of my actions in addressing this problem?
Yeah, I think so. Besides that, we must also check the laws and regulations of our company regarding protection available for us like whistleblowers. These laws may serve as, safeguards regarding retaliation and legal remedies if we face adverse consequences when reporting wrongdoings. And additionally, I think we should also maintain confidentiality by avoiding discussions such as issues with colleagues who are not directly involved in these wrongdoings.
What should be done before misconduct occurs? And as an accountant,
I believe one of the essential behaviors of an accountant is to prevent ethical misconduct, to maintain the trust of the stakeholders. This includes the clients, the colleagues, and also the public. It can be through fully understanding the applicable rules and principles, avoiding situations that could compromise the objectivity, and also disclosing potential conflicts of interest and thoroughly documenting our work. This includes assumptions, methods, and any decisions made. This will help with transparency and also accountability.
Yes, that's true, Linda. Besides fully understanding the applicable rules and principles, as you said earlier, avoiding situations that could compromise your objectivity, as well as disclosing potential conflicts of interest, as well as like thoroughly documenting our work, we can also offer regular ethics training actually to employees of all levels of the organization. And this training should cover the company's code of conduct, ethical decision making, as well as real world case scenarios where firms are impacted.
in summary, the situation involving Company A, Mr. D, and their client Company C is complicated, involving conflict of interest, professional ethics violation, and lack of cooperation. Because of the competing interests of Company B and potential client Company C, Company A's activities were deemed improper. This conflict jeopardized their objectivity and integrity, resulting in biased decision making and inaccurate information presented to regulatory agencies. Throughout the case, violations of ethical precepts, particularly objectivity and integrity, were clear. Furthermore, Company A and Mr. Deal's lack of cooperation during the investigation created concerns. They neglected to submit required information, used personal emails for work related issues, and even backdated meeting notes. These activities jeopardized the pension plan members' assets and had a negative impact on Company B and its employee. As a moderator, I can see that Company A and Mr. D conduct were serious violations of professional ethics, affecting not only their client but also the larger community. The tribunal sanctions are deemed commensurate to the degree of the violation, with the goal of holding offenders accountable and preventing similar instances in the future. This case serves as a reminder of the necessity of maintaining ethical standards in the professional area, as well as assuring integrity, objectivity, and cooperation in all transactions.